Good afternoon, everybody. Ankit this side. I'll be moderating the session. I'm managing partner with Wealthy Nivesh, and with us today we have Sahil Shah, who is fund manager with Edelweiss, and Sahil manages Edelweiss small cap fund, which is one of our recommended funds also. And also I have Mr. Ravikant Mishra with me, who is Mumbai Chapter Head for Hindu Economic Forum. Sir is a fellow IITian as well from IIT Kanpur, and he has worked across L&T and Tata Power. Currently, he is full-time into Hindu Economic Forum after retiring from Tata Power. That's about the introduction of the panel. Now we'll start with the session. So nowadays, the most common question that we are facing from the clients is about market valuations. That market has run up a lot since for last 6 months. And if you look at market valuations, probably they are at slightly higher than the long-term average, around one standard deviation above the long-term average. So Sahil, if you can just start the session with by throwing some light on market valuations.
Sure.
Also, in contrast of large, mid, and small cap categories.
Sure. So first of all, thank you for inviting me here, and good evening to everyone. So just talking about the valuations, and I think given the way markets have moved, at least over last 3 to 6 months, a lot of people have started talking about, are we in a frothy zone? Are we in the euphoric zone that we have seen in 2007 or 17? So it is good to kind of, it would be good to see how valuations have panned out over a longer period of time. Where are we in the cycle of valuation as we stand today? So as you rightly mentioned, that we are slightly above the average valuations that we have seen over a period of time. So for example, in the on the Nifty, if I talk about the large cap, which is represented by Nifty 50, the average valuations have been at around 18 odd times over a longer period of time, which currently is trading at around 19 odd times. So we are slightly above the average as far as the large cap valuations are concerned. So is the case with small and mid caps, where small caps are currently trading at around 20 odd times, and mid caps are trading at around 21, 22 odd times in terms of price earnings multiples. When I look at 2007 and 2017, which in hindsight we can say they were the peak of the market cycle, and post that returns were not being made for at least 1 or 2 years. At that point of time, the price to earnings multiple went to as high as 28, 30 times for small and mid caps. And the large caps used to also trade at around 25 odd times. There was almost a premium of small and mid caps against the large caps of around 20-25 odd percent. Now, as we stand today, the mid caps have moved to a slightly premium territory versus the large caps, but small caps are somewhere around the large cap valuations, are not very different, 19 times, 20 times. So not very different. They are not at 20-25% premium. As such, the absolute valuations are also slightly above the long-term average and not very much higher compared to the long-term average. So if you ask me that between large cap, small cap, and mid caps looks more expensive than small caps, and large caps are the least expensive, right? But there is not much of a valuation difference, so to speak. So we are somewhere in the mid of the cycle is what we believe, and not at the euphoric or a very frothy zone that one would have believed. So that is where we are in terms of the valuation cycle. But the only point to kind of remember here is that we are starting out in terms of our earnings growth journey, where in, let's say, in 2007, we had seen earnings grow by around 25% CAGR for 4 to 5 years. And on top of that, market valuations were at around 25, 30 odd times. As we speak today, the earnings growth has just started out in last 1.5 years after a very, very tepid growth that we had seen for last many, many years, whether it was banking, whether it was capital goods, whether it was housing and real estate, a lot of things. So that's what I think we need to keep in mind.
Great. Davisa, you have some question in mind?
Definitely, whatever we are talking about, Sahil has said that the average, the average is always very dangerous, because some companies average is 5, somebody is 50, somebody is infinite. But if you do the average, then you find, okay, it is 19, 20 for large cap and 21 were saying about mid cap.
Hmm.
My problem is like a shares like HDFC. It doesn't move, but it has got a good P by E ratio. But then at the same time, either Adani, not particularly, there are many others where it is 80, HUL if you see, or Tata Consumer if you see. So for an investor like me, how do you decide which share you should buy? Because some shares which are very highly, as you say, P by E is very high, but still people are buying. So how do you decide which share you should buy and what is the reasonable value? The average actually does not make any difference to a normal person. I should make money. So somebody says you buy HDFC because it's a very good company and definitely it's a good bank. It doesn't move, but there are petty shares which moves by 30, 40, 50%.
Correct.
So how do you describe, for investors? Like one is we come to you and you decide what is to be done because you will have your own formula.
Correct.
But people who are not going through any agent or any mutual fund, how will he make out what should be the real price for a P by ratio for a particular company or a particular sector?
Correct.
That's a
Sure. So I think every sector will have a different price to earnings multiple based on what is the rate growth visibility or earnings visibility, what is the quality of business that you are buying, what is the return on capital that particular business or that particular sector will have. So different companies will trade at different P. So to say, for example, that a consumer company is trading at 50 times or let's say 40 times, it might be cheap for a consumer company. But let's say a chemical company, which is trading at 35 times, might be very, very expensive. So depending on the nature of business, the stability of earnings that we are talking about, the price earnings multiple or the valuations can differ from as low as 5-10 in terms of price earnings multiple to as high as 50-60 price earnings multiple. Now, as we speak today, and as you kind of rightly pointed out, that some of the consumer companies are trading at, let's say, 50 times, 60 times, and above that. So we do see that some of the sectors are overvalued. Some of the sectors are trading at average valuations. Some of the sectors are trading at lower than average valuations, right? And it is important to kind of, when we do our own sector positioning or stock positioning, that is what also we keep at the back of our mind in terms of where we should go overweight, underweight, both based on valuation as well as the earnings growth comfort that we have in a particular sector. So, for example, financials are trading at average or below average valuations as we speak today. For example, automobiles are trading at average valuations that we have seen over past. And as you rightly mentioned, that the average of indices might not be the most relevant thing to kind of look at. But when we kind of segment those price earnings multiple or valuation into different sectors and then further into different companies, that is, and compare it with its own history, is when we can kind of see that where these valuations are we in the middle of the cycle or the top, right? So let's say, for example, last year, a lot of chemical companies' valuations had gone to the valuation multiples of the consumer companies, right? And hence, in last 1 year, chemical companies have underperformed, while the structural growth story over next 5 years for the chemical companies have remained the same as it was in last 1 year. Same thing, I think, happened for the IT companies, right? So a lot of mid-cap IT companies started trading at 25 times when some of the large cap companies in the IT space, in the same space, were available at 26, 27 odd times. So mid-cap was trading at a much higher valuation. So this anomalies of valuation keeps happening in the market, and we have to kind of readjust our portfolio, our stock selection based on that.
Great. So Sahil, just to add on to you, what you said, if you could throw some numbers on the sector valuations of different sectors, valuations of different sectors, means which are the sectors which you believe are positively placed as far as valuations are concerned and which you believe have, appreciated a lot.
So I think, again, we can't just take a broader sector view. I'll answer your question, but we can't just take a broader sector view and then say that I would want to completely avoid this sector because there would be certain stock within that sector which might be attractive. But as you, actually, so in case of, let's say, as I mentioned, financials are trading at less than average valuations. Some of the capital, again, in capital good companies, it is going more polarized. Some of the companies are getting valuations which are like 60, 70 times, whereas some of the companies are still trading available at 20, 25 times earnings, right? So again, within that sector, there is a polarization that is what we are seeing. Automobiles is where we are seeing average valuations. Healthcare as a sector, whether it is hospitals or domestic pharma companies, is where we are seeing companies trading at more or less average valuations that we have seen in the past. So a lot of these construction infra-related companies are trading at valuations which are maybe slightly below the average. So different sectors, as we speak today, are at a different stage of valuation cycle.
Great. And slightly digressing the discussion from valuations, how do you look at inflation and interest rate moving forward? More so in the view that inflation has been tight in the last few months.
Absolutely. So I think if you kind of dissect inflation into two parts, and frankly, I mean, just to highlight that when we manage our portfolios, we don't take any macro calls. While it is true that the macro scenario would impact all the portfolios, indices, and stocks, we can't kind of really forecast where this macro variables are going to go and how they are going to shape up over a period of time. But since you asked the question, so basically, if I had to kind of dissect interest rates into two parts, which is food inflation, which is almost 35-40% of the CPI index, and the remaining is the core inflation. So the core inflation is now steady at around 4.8, 4.5% odd. So that is not going up. What is leading to the overall headline CPI inflation going up is the food inflation. And that is what is causing the problem. Now, obviously, interest rates are not an answer to address the food inflation. And RBI, obviously, when they look at this data, they will look at, they will dissect the data and look at it. However, the interest rate, which were kind of expected to come down by the end of this year, at the start of the next calendar year, that has been pushed out, is what we are figuring out in India as well as in the global scheme of things. So again, I mean, interest rates going down typically, or interest rates going up, we have seen over the last 20-25 years that in certain cases when interest rates goes up, the markets also go up. In few cases where interest rates goes down, markets also go up. So it is not highly correlated in that sense that I mean, while we always wait for interest rates to go down, but it is not highly correlated that always markets will go up.
Probably it's because of lag between interest rate cycle and growth cycle.
That is one of the things. The other thing is that, see, interest rates are used as a tool to kind of also boost the economy or tame down inflation or tame down the high demand that we are seeing. It is used as a tool to do that. Now, between 2003 to 2007, when we have seen the emerging market rally, what we have also seen in India, Fed fund rate had gone up multiple times in the same time period. Now, one would have imagined that if the Fed fund rate is going to rise by multiple times, markets would have gone down, but that was not the case. We have also seen in the COVID times when the interest rates have been brought down to zero, markets was kind of going down, and post that the post-COVID rally started. So it is not always correlated in that terms.
But I have one question, Sahil, that the stability of the government, that is already a factor that we know that, like we say, that next 5 years, 10 years is the time for India to grow. But if anything happens in between 2024, are we prepared for that?
So I think from a market standpoint where we are right now, I think markets will take a knock if there is a adverse result in election, and if the opposition party were to win, then markets will take a knock. But see, even again, going back to last 20, 25, 30 years, while there have been changes in the government, uh, I mean, there was UPA government where we have seen this rally of 2003 to 2007. We have witnessed, I mean, Modi government coming in 2014, and post that till 2017, we have seen a good rally. Then 2018, we had our own Ireland FS crisis, which was more India related and not related to anything to do with US or some of the developed markets. So I think while elections do matter, but I mean, if I think so I think the broader point here is that a lot of good things that have been done in the past by the existing government, which is cleaning up of NPAs from the banking system, corporate balance sheets have been cleaned up, the demand is coming back, the geopolitical thing is in the favor of India, which is now leading to more manufacturing in India. PLI schemes have been introduced to kind of incentivize those manufacturing in India. Now you can know, I mean, if there is an opposition government, they cannot come and suddenly stop all these things, right? So what the ball that has started to roll, I mean, it will roll for next at least 2 to 3 years, even if there is some adverse election that will come.
Let us hope for the best. So
Yeah.
now coming back, what is the reason for the rally in defense sector and railways stocks of government? It's a phenomenon. A share of 200 can go up to 1,000 in 3 months' time. Do they justify the price increase?
I'll just yeah. So valuation wise, I'll just talk about, I mean, what has changed on the defense side and also on the railway side. So I think on the defense side, one clear the thing that has been driven by the government is indigenization of defense. So if you look at the defense expenditure in India, overall defense expenditure, it is around 6 lakh odd crore on an annual basis, out of which around 2 lakh crores is the capital expenditure. That is where we spend on buying tanks, ships, those capital expenditure thing, and the remaining is the revenue expenditure, which is pension, salaries for the defense personnel. This 2 lakh crores is likely to grow, which used to grow at around 6-7%. It is likely to grow, first of all, at around 10 odd percent, 10 to 11 odd percent. So that rate of growth or the expected rate of growth has kind of changed over next 4 years. Secondly, we used to procure almost 45% of our capital expenditure from India, and the rest was being outsourced from some of the developed countries, right? Now this ratio, 45-55, has now changed to 75-25. 75% of the procurement happens from India, 25% from outside India, and this will move more towards 85 being procured from India. So one is that your rate of growth has changed at a very broader level, and then within that, the sourcing that is happening from Indian companies, it has been going up massively. So this is leading to a very high growth rate, or at least the expectation of the high growth rate is there for a lot of these Indian listed defense companies. So I think that is the fundamental change that has happened in the defense side. I think valuations, I mean, the stocks have run up, but I think valuations are slightly above the average, but the earning visibility has gone up far more. One more point I would like to add is the export opportunity in defense. Given that our forces or our army or navy was not using India manufactured equipments in the past, which they have now started to use. What it has done is it has given confidence to a lot of other countries. And now we are seeing that some of the missile orders or plane orders or fighter jet orders are being taken up by some of the other emerging countries that have now started to, I mean, there's an export opportunity that is emerging from India to those countries. So these are the things that have emerged. Now, coming to the railways, railway side of the business, I think if we look at last 50-60 years post-independence, the railway network in India has, we have underinvested in the railway infrastructure for a very long period of time. And what this has led to is that if you look at the overall transportation that happens in the country, almost I think 60-70% used to happen through railways 50-60 years back, which has now come down to almost 25-27 odd percent in terms of the share of transportation that railways has. A government with this dedicated freight corridor, which is I think more than half operational, and most of it will get operational in next 1.5-2 years. This eastern corridor and the western corridor, that is going to kind of change the game, the way we look at railways. And government has laid out a vision that they want to increase the share of railways from 27% of the overall share of transportation to 45% over next few years. Now, as that happens, so the way it has happened is that first you build infra, which is your rail tracks, and then you can start ordering for more wagons, and that is how you kind of increase your share, moving up from 27 to 45%. So the track laying has happened, the infra is now built out. So now the wagon ordering plus this Vande Bharat opportunity, which is now emerging. So all those things are kind of taking shape, which is leading to more orders for some of these wagon companies.
Great. And Sahil, so from specific, I am taking you back to generals again. So what is your outlook for next 5 years on economy, on markets, etc., etc.?
Yeah. So I think I truly believe that we are somewhere, we are coming out from a cycle where we have seen the worst of everything. Whether it was housing sales, which was very muted for a very, very long period of time. Private capex, which was very, very muted for a very, very long period of time. Auto sales, whether it is cars or two-wheelers, 2018 was the peak. From there, we have seen car sales dropping by 25-30%, two-wheeler sales dropping by 40%. Now, in last 1.5 years, is when we are seeing the recovery in whether it is private capex, whether it is housing sales, whether it is cars and two-wheeler sales. So I believe that if you look at the order book of ABB, Siemens, Cummins, Thermax, these are the capital good companies. Their order book has gone up by 25-30% odd, which was not the case 4 or 5 quarters back. If you look at the credit growth, overall credit growth in the country, this used to be single digit 1.5 years back, which has now gone to double digits, right? So a lot of things have changed, and this is just 1.5 year that we are talking about. Typically, whenever the cycle, earning cycle or the economy cycle in India, what we have seen in the past, it goes on for 4 to 5 years. And now with this geopolitics, which is in the favor of Indian markets or the Indian economy, and with government taking right steps to kind of incentivize it with PLI and some other benefits, I think we can see a very good growth rate over next 3 to 5 years for India. For next 2 years, the projections in terms of the earnings growth for the large caps are at around 15% odd. For small and mid caps, it is around 20% plus. And if you believe that the share prices are slaves of earnings compounding, then obviously that is how the share prices should shape up over a period of time, given the valuations stay where they are today.
Great, very informed suggestion. Sir, Ravi sir, you have any question?
Yeah, Sahil, tell me, one is this PLI. PLI is not a scheme which is going to remain forever, right? After some times, government will start withdrawing. What will be the effect on the market?
So I think, if you look at the overall capex in the country, that is almost around 60 lakh crores, right? Every year the annual capex is 60 lakh crores. If you further split that up into housing, it is around 25-30 lakh crores. Government and state capex is at around 20 lakh crores, and private capex is 10 lakh crores. Now the PLI incentive is at around 2.5 lakh crores, and the PLI capex that is going to happen is around 4 lakh odd crores. Now this is going to happen over next 3 to 4 years. So consider that this is going to be 1 lakh, 1.5 lakh crore capex addition that is going to happen. Now we are talking about a number where PLI was not there, but still we were doing around 60 lakh crores of capex, and there is an addition of around 1.5 lakh crores. So from that perspective, it is not going to change much. I think what PLI is trying to do, and that is, I think, very important to kind of understand, is, I mean, it is not that this is the first time that governments have come out with a scheme or an incentive scheme to kind of boost manufacturing in India. There was MEIS benefit, there was export incentives, which all these listed companies and maybe unlisted companies would have been getting. But what PLI is doing is that they are saying that if you are able to produce something at a certain scale, is when you will get incentive. So what government is saying is that you become globally scalable companies over next 4 to 5 years, and that is where we'll provide incentive. So it does two things. One is obviously it generates employment. It allows companies to kind of to help them to transition from being small to quite large in the global scheme of things. And as you end 4 or 5 years hence, the scale itself will give you a lot of economies of scale, which will help you to compete globally without PLI, right, in most of the sectors. So I think that is the inherent advantage, I think, that PLI should bring in over next 4 to 5 years.
Oh, thank you.
Great. So, Sahil, as you mentioned, top-down approach for equity analysis. So, I'll bring it to the discussion as well from markets economy. Let's move to portfolio. So,
Sure.
I have very, very layman kind of questions for you. Some of questions. So, one is, what do you think is the best time to build portfolio? One thing, and which approach do you think is better, SIP, STP, or lump sum to build a mutual fund portfolio? And I like your answer from the perspective of a first-time investor. If somebody is building the portfolio for the first time, one perspective. Second, a lot of investors nowadays are, rebalancing their portfolio now that markets, as per them, have appreciated a lot. So they look at it as an opportunity to, rebalance some of their portfolio, eliminating those part of the portfolio that they were not that much, good performing funds, etc., etc. So some of your views about these things.
Sorry, I was not able to get the last part of the question.
Last part, I was saying, in these market conditions, a lot of clients are rebalancing their portfolio, and they look at this opportunity to eliminate part of their portfolios which were not performing well, and replacing them with better performing funds or better performing avenues. So, what are your views in those in that scenario? Should they go for lump sum, STP, or should they go for SIP? What kind of approach would you suggest them?
So I think for a first-time investor or even for a matured investor, I think I always believe that especially when you are investing in a category which is volatile, like small and mid caps, you should always go with SIP, right? Because we don't know what is going to happen in next 3 to 6 months. While we can be more clear about how things will shape up over next 3 to 5 years, 3 to 6 months. I mean, if let's say there is a hard landing in US, right? Some economic catastrophe that happens in the US markets, we never will come to know in advance. So there, I think SIP is the best route to kind of enter, especially for the first time investors, into the small and mid cap category, or if it is even a multi cap category for that matter. More importantly, if it is if he's a first time investor, and if he doesn't require money for next 3 to 5 years, if he's looking out to build wealth, where he wants returns which are higher than large caps, maybe a multi cap approach towards portfolio allocation makes a lot of sense for that kind of investor from an SIP or an STP standpoint, right? So if you have a lump sum, you typically do an STP where you put money in the liquid fund, and then you kind of it gets automatically triggered to your from debt to equity, right? If you have a regular income, you do an SIP. But I think that is a more disciplined way of investing money rather than putting lump sum. Sorry, Ankit, you are on mute.
Sahil, thanks for validating our approach because that's what we have been doing precisely for last 8-9 months. So we have a multi-cap approach. We have an all-cap portfolio where we have 2 large cap, 2 mid-cap, and 2 small-cap funds. And even if people bring our investors bring money in lump sum, we get it deployed by STP only. So whatever you said is verbatim what we are saying. So very glad to know that. For the benefit of our audience, if you can throw difference between flexi cap and multi-cap approach.
So, there are 2 categories of mutual fund, or out of the various categories of mutual fund that exist, there are 2 categories which you're talking about, which is flexi cap and multi cap. So, for an investor who is more risk averse, which is who has the ability to take lesser risk, I think flexi cap funds are better suited for him because large caps typically are at around 70-75% of the overall weightage in terms of portfolio, which tends to be less volatile, but also the returns are slightly on the lower side as compared to the small and mid caps. As far as the multi cap is concerned, which is meant for a slightly more aggressive investor, is where large caps typically are at around 40% in terms of allocation, and the remaining 60 is split between small and mid caps. So depending on the risk appetite, whether you are more on the risk averse side or more on the risk taking side, one can kind of select an appropriate fund which is either flexi or multi cap.
Sahil, what is this passive fund which somebody has entered with, and what is the effect of Geo Financial in the mutual fund market? Will they affect somebody, or it is just like one of the fund coming in?
Difficult to guess as of right now because we don't know what their strategy is, whether they will be going passive, smart beta, or active fund management. But at least what I can see around, what I can see in terms of how people want to invest in Indian markets is that in categories like small and mid caps, there is still a lot of scope to kind of create alpha over the benchmark. And hence, as we are seeing as of now, that passive products are not picking up in this, at least these 2 categories. Then there is a multi-cap category where again you have more small and mid caps. So again, the ability to create alpha there compared to large caps, it is on the much higher side. So I think if, let's say, if I had to assume that Geo Financials will come through passive products, then obviously, small and mid caps or multi-cap kind of funds will still remain active in India, at least for next 4 to 5 years, as I can see from today.
But what is a passive fund? I'm just trying to understand. There are so many funds, active funds, passive funds.
Yeah.
But it is the money they are going to invest somewhere.
Yes.
So it's called passive funds. Why not active?
So you are saying what why one should go for passive funds, or you are saying what is passive fund?
What is a passive fund? Then only I will decide whether I should go with passive fund or I should go for active funds.
Okay. So
what
passive fund typically will mimic the index, right? So let's say, for example, in Nifty 50, if you have 10% weight of Reliance, 5% of HDFC Bank, and so on, ABCD stocks will have different weights. Passive funds will just go and mimic those weights in the portfolio. So it is not actively managed. In an active fund, on the other hand, the fund manager will take active bets. So, for example, in our funds, especially in the small and mid cap funds, more than 70% of our funds have active bets. Now,
changing.
Yes, you either change it or you are not in line with the index, right? So if you have to outperform the index, you have to be different than the index. If you are in line with the index, you cannot outperform the index, right? So passive funds are for funds which will kind of mimic the index in terms of stocks that they will buy with the same weight, same kind of stocks, same name of stocks, which will give you similar returns as what the index will give you.
Okay, Ankit, you can go ahead.
Sahil, I have coming back to multi-cap, flexi-cap only. So if you look at long-term returns in India, large cap 15%, mid cap 18%, small cap 20%. So one can say if you have a equal weighted multi cap kind of approach, that should give you 17-18% index returns. And over and above that, if fund manager is able to generate 4-5% kind of alpha, which I think is fairly achievable, even if you discount the probability of getting alpha in large cap. So do you think having an expectation of 20-23% annualized returns over a period of 5 years is genuine coming to multi-cap for the next 5 years?
So I won't be able to comment on future
Liking the
returns.
smile on your face, that answers the questions.
No. So I can't give any forward-looking guidance as far as the returns are concerned. But I mean, if I have to talk historical returns, I mean, you said it right that large caps have given lesser returns as compared to small and mid caps, and a blend of large, mid, and small can offer you better returns as compared to investing in only large cap funds. So that is what the history suggests, and I would believe that can continue for next 5 years as well.
Sahil, around in the month of January, Feb, we came out with an article where we said that there is a huge arbitrage between the valuation of small cap and large cap at that point of time, which I believe has converged now. So if you look at returns, small cap has given around 20% more than the large cap in last 7-8 months or 6 months kind of horizon. I may be slightly here and there, but conceptually that's how it is. So moving forward, do you think a more large cap oriented, now assume it ki I can take all the risk. So for next 5 years, what do you think, taking in view that now that all three categories are almost at same valuation, almost 10% more than their long-term average. So does an equal weighted multi-cap makes more sense, or a more large cap oriented sense makes more sense? And this is again, let me give the disclaimer, ki assume that I can take all the risk. And I am somebody who had been always into multi-cap only.
So I think then from a 3 to 5 year perspective, it always makes sense where the small and mid cap proportion is higher, which happens with the multi-cap fund. It makes sense to go with that kind of fund because one is valuation part, which you said that valuations have now converged, which is true. But the other is the earnings growth part. So I mean, returns are made with two things. One is the earnings growth and the valuations, right? It is a combination of these two things. When we look at the earnings growth, the large caps earnings growth is expected to be at around 15% over next 2 years, whereas the mid cap and small caps earnings growth is expected to be at around 20% plus. So there is almost a 5% delta in terms of earnings growth between small mid caps as compared to large caps. Now, this is not only where we're talking about next 2 years or 3 years, but even historically, when you see that when you kind of compare companies which have been small and mid caps in the same categories or sectors, they have always, or not if always, but if you are able to select right companies, then they always deliver more earnings growth and hence more returns as compared to large caps in the same sector as well. And what happens within the sector, I mean, index or the portfolio is the summation of all the sectors that is there. So that way, I think if you have a 3 to 5 year horizon, looking the way earnings are expected to grow, a multi-cap approach is more suitable. Just last point I would like to highlight on this question is that if you look at the large cap earnings profile, almost 35% plus comes from the globally linked sectors, right? Globally linked sectors meaning either a companies into commodity business like steel, aluminum, where the prices are globally linked, or they have an international subsidiary, like for example, Jaguar Land Rover will have a subsidiary in UK, or you will have a significant export, like in the case of IT. So globally linked sectors are not expected to do as well as what we are going to do at the domestic level, right? So developed economies are seeing, let's say, for example, in US, we are talking about at the start of the year, we had the Silicon Valley Bank crisis, First Republic Bank. In China, Evergrande, which is one of the largest real estate companies, they have filed for bankruptcy. So some of the developed or very large economies are going through some trouble or the other, we have come out of the trouble, right? NPMS, housing crisis, and so on and so forth. So that way, I think domestic oriented portfolios will do much better as compared to globally linked portfolios in general. And given that the proportion of globally linked earnings is more in the case of large caps, I think at least over the next 2 to 3 years, given that domestically we are much better poised as compared to developed economies, I think small mid caps should do much better.
That's an amazing insight, Sahil. Sahil, I have a very sector-specific question. So, if you look at the banking sector, NPAs have come down from highs of double digit to lower single digits. But if you look at returns, they have not been that much great. So, do you think banking has got, as compared to other sectors, banking has got better prospects?
So yeah, I think so. Because see, if we are talking about domestic economy doing well, we are talking about a lot of capex that is expected to happen. If we are talking about order book being built up in some of the larger capital good companies, then obviously all these things will require capital and finance, which will be kind of be provided by these banks or NBFCs which are there. And clearly, we have seen that the single-digit growth rates in terms of credit growth have now come up to double-digit credit growth numbers that we are seeing now. So NPA cycle is kind of behind us. Growth numbers looks on an upward trend, or at least they will be in double digits for at least for a considerable period of time. I think because of the interest rate cycle movements where interest rates went up, we are seeing some lag impact of that in terms of net interest margins or margins of the banking sector or NBFC sector. I think 2-3 quarters down the line, this will also kind of ease out or normalize. And then the true earnings growth will kind of is what we will see in some of these banks and NBFCs. So yes, so we are positive on the banking sector.
Yeah. Ravi, you have any question?
Yeah, I have one question. Sahil, tell me that I watch, G Business and other this televisions, and I always find that two different bankers, HSBC or Jaffrey, one fellow will say the price will go up, and the other fellow will say the price will come down. Is it that they have hand in glove to make the situation worse? Which one people should follow, and what is the reason behind that?
I think they should not follow anyone.
And the television shows that. So I do not know it is they are driving the market or the brokers are driving the market, because they will say that moving average is like that, so it has to go up. And whether company is doing well, not doing well, whether prices are being manipulated, but somebody only watches the curve and then says that now the time has come for it to go up, so you buy.
Yeah.
Sahil, before you answer, I'll have an interjection over here. So, sir, there is a report by SEBI which says that 99% of the traders in the market don't make money. They make negative, they make losses.
I see.
And when it comes to 1%, in 1%, they have counted even those people who are just making break even.
Okay.
So even under this 1%, there would be a large number of people who would be making less than FD or equal to FD kind of returns. So I think it's all noise over there, and more Sahil will elaborate on this. I just wanted to bring up this.
I know that unnecessarily people get caught in this, and they may not make money, as you have said.
Yeah. So I think that's a that's a very valid data point that you kind of highlighted. Even on the cigarette packet, it is mentioned that smoking kills, but still people drink cigarette. Yes. So even in this case, when SEBI came out with the data, I always see that the volumes have gone up even after this data has come out. So people are trading more somehow.
Expectation they'll make money, but maybe they're not making money.
Yeah. So, but I think doing your own research on that particular stock, and I'm more inclined towards fundamentals rather than technicals.
Yes.
So doing your own fundamental research, spending time on that particular company by reading annual reports. Now we have con call transcripts where companies regularly do quarterly con calls for most of the companies that are listed in the space. Going through that, that can give you a lot of insights about understanding business cycles, what companies planning to do. So those things I think one should kind of read and then invest, rather than just following those tips, which kind of comes out on the TV channels.
So that brings it back that we should go by the opinion of mutual fund managers. So
yeah,
which one is yours?
Yeah,
So
so I think
so to counter that only, sir, SEBI has this regulation कि fund managers can't speak on specific stocks.
Okay.
So, even if you start asking Sahil about any specific stocks, he will come out with a
No, so I'm
disclaimer.
not asking about specific stock. I'm asking about the which one, like whether I should go for HDFC, I should go for ICICI, I should go for XYZ. Which is that mutual fund company a person should invest?
So I'll take 2-3 lines on this, Sahil, if you would allow me.
yeah.
So, sir, there are two layers. One is which equity to invest into. I think if you ask me, a lot of clients ask us also to give us some recommendation on equity. And certainly we are bound by a regulation not to do that because we don't have relevant license. But even apart from that, I always ask them, how do you think if, a small team like us with limited resources can match the expertise of, let's say, an Edelweiss team where they would be having 10 or 20 analysts tracking funds, and somebody like Sahil who has put in 2 decades into markets. A lot of companies, Sahil can cite you balance sheet on his fingertips, and the kind of insight that he's doing. So that's the only work that he's supposed to do day in and day out. Over and above that comes the layer of mutual fund distributors or advisors, people like us, who tells you which mutual fund you should go into. Like for us, I can cite you, at least for us, how we do it. We have a data API from a very respected data agency. Over and about that data, we have built our algo, which has been built by my partner Aditya Gupta, who is IIT Roorkee and ISB Hyderabad medalist. Basis that algo, where we do multi-factor analysis, etc. We look at Sharpe, Sortino ratio, we look at risk return metrics, etc. We build a portfolio which we believe is in sync with your requirement. So I think, I would say, instead of going for these kind of approaches where people, as you rightly mentioned, people go to, CNBC, they look at what is which stock to buy, which to sell, and then they decide to put in their hard-earned money into there. A more robust approach would be to go through experts.
Now, people who know the job.
Yes. Sahil, you have more to add on this?
Well, I think you have rightly summarized that. So nothing more that I want to add.
Great. So, this discussion reminds me of Einstein's theory of relativity, because the discussion is going so well, we missed the count of time. So, Sahil, probably what we can do, you can, speak a little bit on your small cap and your upcoming multi-cap NFO. And then we can open for then we can open the audience for 2-3 questions. Is that okay, Sahil?
Yeah. Perfect.
Great. Yeah.
So see, I manage the small cap fund, and the fund so far has been very consistent. We launched this fund in 2019, which was not a great time to kind of launch a fund if we if a mutual fund house like us wants to kind of have more AUM, because typically during worst times you don't get AUM. But if you kind of get investors during some of the worst time, that is when you kind of make best returns over next 2 to 3 years. So that is where we had launched our small cap fund, and it has done quite well for us and for our investors. In terms of some of the themes that we kind of like within the small cap space, which you would also see in our portfolios, is one of it is the QSR theme, the quick service restaurant themes, where and we know the names which are there in that particular space. You can look at our portfolios. That is one thing that we like. We are overweight on capital goods space. We are overweight on the housing capex theme in India, because we, as I said, we are coming out from a phase where we had seen a very muted or a very tepid growth as far as the housing sales is concerned. We are overweight on automobile space in the small cap space. So these are some of the sectors we are overweight on. We are underweight on IT, slightly underweight on IT, and we are also underweight on the chemical side of the on the chemical sector as far as the small cap fund is concerned. So typically in small cap fund, what we don't do is basically we don't buy large caps into small cap fund because as our mutual fund distributors, our clients would have already decided their allocation. We don't want to kind of over allocate certain market cap categories. They invest in small cap fund to invest in small cap companies. So we have small and mid cap companies only in the small cap portfolio. We don't take cash calls because again that is what clients would be taking at their own end. Our cash levels will never be more than 5%. We don't take outsized sectoral calls. So we don't go overboard on a certain sector. We don't go completely out of some of the major sectors which are there. The idea of to do all these things, we are also style agnostic in that sense, investment style agnostic. The idea of doing this is to kind of focus on just selection of stocks and not kind of take macro calls, take cash calls, or take very big sectoral calls. The idea is to make money through selection of stocks, and that is what small caps that is what a small cap manager is supposed to do. So I think this is how briefly I would summarize our small cap portfolio. The portfolio price earning multiple stands at around 21 times, with a return on equity at a portfolio level of around 19%, which is more comparable to the average of the large cap stocks. So the return on equity or the return on the business that we are looking at a portfolio level, it is more comparable to some of the large cap companies. Price earnings multiple being 21 times and future growth being at around 20% plus. So that's how I would summarize our small cap portfolio. Now coming to the other part of the question that you asked on the multi-cap fund that we are planning to launch or we are launching. So there again, see the approach will be that what SEBI says is that we have to invest minimum 25% into large cap, small cap, and mid cap each. What we have kind of what we are seeing is that our large cap percentages will be somewhere around 35 to 45 odd percent, and the remaining will be invested into small and mid caps. So it will be a more small and mid cap oriented portfolio. And what I have highlighted in terms of why small and mid caps can do much better as compared to large caps over the next 5 years is what remains true for the multi cap fund as well as we speak now. And last point that I would like to mention on the multi-cap side is why this approach is better is because one is that from a client, and this can be a core of the client's portfolio, given that you will not need to allocate between small, mid, and large caps because it is a full package that is available to you. Second is that our expertise in the small and mid cap fund. I've been doing small caps and mid cap for the last 16 odd years. The team is very well equipped, and you have seen our performance on the small and mid cap side, which has got an exceptional track record, if I may say so. So our expertise lies in the small and mid cap space. That is where we can generate alpha, and there are certain sectors, like for example, let's say financials, where you find much better banks or NBFCs as compared to small and mid caps. There are certain FMCG companies where you don't find such FMCG companies in the small and mid cap space. But then there are also sectors like capital goods, consumer durables, automobile and auto components, where you will find or chemical companies or some of the electronic manufacturing services, which is now emerging business in India, which are available in small and mid caps, but they are not available in the large caps. So this blend to get the best or the best leaders within that particular sector works very well as far as the multi-cap approach is concerned. Ankit, you are on mute.
So now we open to the audience for Q&A. First question comes from Karnam Naren sir. And he has asked actually the question that I was about to ask also. As a fund manager, how do you navigate black swan events and how do you navigate market-induced corrections with or without underlying economic issues? As per him, this underlines the uniqueness of the fund manager and accordingly the fund performance. But I have another question, Sahil, in addition to this, and it is slightly similar. How do you quantify the corporate governance? Because I think that's the most critical part for a small cap fund manager.
Absolutely. So one is, so as I said, we don't take any macro calls to kind of change our allocation in the portfolio, because the macro events, while it does impact the markets and the portfolios from a short to medium point of view, but over a longer period of time, I believe that those things get ironed out over a period of time. So taking more calls more on stocks and stock selection, and also some of the themes that are going to work in India over a longer period of time. I think over a longer period of time that makes more money than kind of getting into macros. Now coming to the corporate governance aspect or capital allocation in the smaller, it is very important because there are almost 500 to 600 small and mid cap companies which are available for investments, and to filter out or filter in those ideas out of that large pool, it is very important. So we have a process known as FAIR framework. This is an abbreviation which stands for forensics, acceptable price, ESG informed, and R stands for robustness of the business. I think the two most critical elements are forensics and robustness of the business. So in forensics, we kind of do our desk research whereby we look at ratios for a long period of time for the companies that we are planning to invest in, which is where we basically want profits to be converted into cash flows, because it is not that easy to manipulate the cash flows. So it's difficult to manipulate the cash flows, and hence cash flow becomes very important or integral part as far as we look at companies. The other aspect is we kind of compare each and every expense line item or the capex that company has done with some of the other peer sets which are available, and try to figure out whether the companies that we are kind of evaluating, how do they lie in terms of efficiency in capex, efficiency in expenses, because that is where managements typically will take out money, right? Either through expense line item or either through capex. We look at what is the cash tax rate within that particular company to understand what is the actual cash tax that the company has paid. We look at the number of employees in that company and compare with the EPFO data, which also where we have access to. So those things kind of help us to understand whether companies are over-reporting profits either or under-reporting profits, and we want to avoid both such kind of companies, which should not be part of our portfolios. So this will help us reduce the error or mistakes that we would make by a significant amount, as we have to kind of only once these checks are done is when the stock becomes eligible for investment. And then we look at robustness of the business, basically whether it has leadership in the business that they're operating in, whether they're growing at a faster rate as compared to the other competitors, what is the return on capital employed, how involved is the management, or how focused is the management in that particular business. So I think these are the aspects that we look at as we kind of bring stocks into our portfolio.
Yeah. Hi, Sahil.
Hi. Hi, Aditya.
Yeah, hi Sahil. This is Aditya. I'm from Wealthy Nivesh team only.
Yeah, hi.
I'll look after the product and research over here. So one thing that we analyze in small cap funds when we are advising to our clients is the AUM size. And we have seen that your fund has given quite consistent performance, and it's also in our recommended list. But your fund size is about 2,000 crores, but there are certain small cap funds who are around 20,000, 30,000 crores. So as a fund manager, how difficult
is it for you to manage an incremental amount of AUM that you get on the size? So that's one of the things that we carefully look when we are recommending any small cap fund. So what's your take on that?
No, that's a good question, Aditya. So I think I'll just come to the liquidity part of our uh, liquidity part of the fund, where we basically, if you look at our fund, 85% of our portfolio can be liquidated in less than 5 days. And this is a hypothetical situation because it is not going to happen that on a single day we are going to get 2,000 crores of redemption. Now, when we kind of calculate this liquidity number, we take 20% as our participation rate in the volumes. So if we are able to participate in 20% of the volumes and not 100%, that is when this number comes where we can liquidate portfolio, 85% of our portfolio in 5 days. That also kind of tells you about the question that you asked, that if there is incremental flows, or if you want to kind of exit one particular stock because of some of the other reasons where our investment thesis is not playing out, or we have found out a better opportunity, the impact cost for the fund like us is very, very minimal as compared to some of the larger funds.
Understood, Sahil. Any other audience has any question? Ravi sir, you have any question? Any more question?
Yeah, hi. Can you hear me? Am I audible?
Yeah, Mr. Seth, you are audible. Tell us.
Yeah, hi. So,
Yeah, hi.
we have seen a inflation hike recently. What is your take regarding that in the mid-cap sector?
So on the inflation, you're saying that what is the impact on the mid-cap stocks, right?
Yeah,
So, see, I mean, inflation, as I said, has been more driven by food inflation. Uh, and I think when we kind of look at the companies in our portfolio and in general, uh, the company's margins get impacted when there is a lot of commodity inflation. This is what we had seen during Russia-Ukraine war crisis, where crude prices spiked to more than $100. Steel prices went through the roof. So at that point of time, margins were for a lot of these companies where input is steel, aluminum, or crude based derivatives, the margins got impacted. Now we are in a situation or a scenario where obviously some of these commodity prices have started to rise again, but we are not going back to the scenario where there is going to be a sudden or a big spike. At least that is what we can see is that the margins will not be impacted because of the inflation that is coming out from the commodity prices. So I think commodity prices being more or less stable, we don't foresee an impact of that on the mid cap or the small cap companies.
Sahil, Naren sir has repeated his question. He believes that his answer, maybe we lost his question in between other discussion. So he
Sure.
wanted to know, how do you navigate bland swan event and market induced corrections like 2-3% here and there without underlying economic issue. So how do you navigate such events?
So frankly, see, we don't hedge our portfolios, right? These are like open positions which are there. Neither do we kind of take very, very active calls that I mean, if first of all, black swan events are events which we cannot foresee sitting today, right? So let's call it COVID event, right? COVID was one of the black swan events that happened. I would say that Russia-Ukraine war was one of the black swan events that happened. So you can't foresee that this is going to happen. Now, in those circumstances, you always kind of act when you kind of get to know about that particular event. So in that particular situation, we kind of reevaluate our portfolio for all the stocks that we own in terms of what would be the impact of that particular event on this particular stock. Now, wherever the impact, so one is the market impact, market-driven impact that will be there for most of the stocks, right? But then there will be certain stocks which will be impacted more than most of the other stocks. So, for example, during COVID times, it was very clear that people are not going to go out of their houses, and hence, let's say a movie exhibition business like Inox or PVR would be more impacted than most of the other businesses, right? So obviously, that is how you kind of assess where the impact is market neutral, is where most of the stocks will behave because of that particular event in a similar way. We don't take any action, but where we find that markets have or the earnings of that particular company are going to be impacted over next 1 year, at least in the medium term, then obviously we will take an appropriate action in our portfolios as and when that black swan event unfolds. But we can't predict the black swan event, and that is why it is black swan event. So that is how we kind of we will act on the portfolio as we will come to know about the event. And the second question was, if you can just repeat the second question, it was you're saying the market induced correction plus minus 2-3%. So what was the question? I mean, if market goes up and down by 2-3%, then what we do, right? You are on mute, Ankit.
Naren sir, would you like to ask the question directly on audio?
Sure. So thanks, Sahil, for the patient answer.
Yeah.
So what I was trying to understand, like you clearly mentioned, black swan events will not be known. Otherwise, they won't be called as black swan events. But with the hindsight of all these things, I just narrated a few. With China economic crisis deepening or Europe inflation crisis worsening, and both China and Europe started to impose restrictions on certain products, certain things. Now, these are some of the negativities which the world is likely to throw up across the globe, and definitely they'll have an impact on India, with India taking a greater share in the world order, in world economic. So while domestic demand, we don't have a problem, but anything that we are catering to the international market will be definitely be impacted, and accordingly the markets. So basically that is one I would put it under, whether we call it as a black swan events or sub market induced corrections, which will be like 2 or 3% is just a number. It could be 4 or 5%. So typically what happens is when the investments are made, when an individual is making the investments, maybe the experience or the insights which a fund manager will have on the performance of the company, etc., that much the individual may not have, HNIs or a retailer. But at the same time, he has the flexibility to deploy his own funds as per his choice.
Correct.
But in case of fund manager, since he is not involved, it is left with the fund manager to take care of these things. That is why my question is, the performance is definitely going to be hinged, and we cannot, usually people talk about long term, short term, etc. So I'm talking about a 3-year time frame or a 5-year time frame, and people can say, forget about it, just invest, and whenever you need money, whether it is 5 years or 7 years, you take care of whatever is the situation at that time. But I am not looking at that philosophy. I'm only saying that I will go with a fund manager with a philosophy that anything from 3 years onwards, I need to have a clear visibility on fund performance. I cannot say, anybody cannot commit that it is going to be 10% or 12% or 15%, fine. But then there has to be some modus operandi, how the fund performance is taken care during these these serious corrections.
So as I mentioned that whenever these black swan events unfold, and as you said that given that we have a better understanding in terms of understanding where the business is coming from and how whether it is raw material or whether it is geography exposure that a particular company would have, or other kinds of exposure that these companies would have, we would have much better understanding on this. we kind of take appropriate actions once these events unfold as quickly as possible. So I can just give you one example, which during COVID times, what I did in the portfolios that I used to manage at that point of time, which can give you some flavor about what we do, or at least what I have done in the past. As I was sharing this Inox example, and as you talked about Black Swan event, that is what came to my mind. So I used to own Inox Leisure before this merger of PBR Inox was there. When COVID happened, it became very clear that at least from a 6 months perspective, nobody is going to move out of their houses. Nobody is going to go and watch out movies at that point of time. And this was a business which was highly impacted because of from a 6 months to 1 year standpoint. This business is run on a fixed cost business. They have to pay rents, they have to pay salaries. So it was very apparent to us that this will report losses in that sense. So that way we took action at that point of time. Now, obviously, the price at that when before the COVID was around 280, 300. It went down drastically to 120. Now, whether we should act at 120, the answer was no, because again, then we have to kind of go back to the thing that markets will always overreact or underreact to most of the situations. So we have to take care of how the fundamentals have changed and how the prices have changed, and then act accordingly. But again, the prices bounced back, and that is when we kind of got out. But however, over the period of next 2 to 3 years, if we would have held that particular stock in our portfolio, we would have underperformed significantly as compared to the markets. So that call went right in that sense. So that way, I think we kind of change our positioning based on how this Black Swan kind of events would happen. So one is the Black Swan events. The other is also the events which will happen, which are more company specific in nature. So again, there also we will take portfolio actions as and when required. And not just kind of buy and sit on for certain companies for next 5 to 10 years. So whenever there is a negative news, and if that warrants an action, we'll certainly take that action. That is what we have been doing in the past as well. I hope that answers the question.
So, Sahil, can we say that Ukraine-Russia war is behind us and happy days will come? and as well as the Hindenburg.
Yeah.
Hindenburg.
I mean, yeah. So Hindenburg, I mean, again, at least the impact of Russia-Ukraine war on the commodity prices, on a lot of things, have kind of now it is a non-event now. I mean, it was an event at one point of time. It has now become a non-event. Again, Hindenburg is a very report is very specific to one particular group or a company, which we don't own in any of our portfolios. So, doesn't matter. What.
But it affects the market. See, the organized criminals
Collateral damage.
go from one company to another company, maybe tomorrow from other companies. And it creates disturbance. So you people definitely will be having your way of meeting such situations.
No, so frankly, when Hindenburg's report came out, we as I said, we have to kind of go if there is a fundamental impact on a company earnings, which we own in our portfolios, is where we can take action. If something is going to impact the market, then we have to take a cash call, which we don't do at our end. So that is if you think, or if one believes that there is some impact that is going to happen at a market level, then obviously either you do SIP, or either the mutual fund distributors can take a cash call at their end, or clients can take cash call at their end. But we are not allowed to take cash calls at our end.
Okay, thank you.
Yeah.
Well, again to mention about theory of relativity. We overshoot our time. I think we decided for 1 hour, but it's already 1.25, and we are still not feeling like calling it a day. But anyhow, every good thing comes to an end. Thanks a lot for joining us. Thanks for all the insights. My favorite insight of today was that large cap has got more correlation with world events than small and mid cap. And your focus on domestic economy of India. And I think that's a very valid point. We have been able to surmount a lot of global crises because we are not that much export oriented. Thank you, Sahil. Thanks a lot for all the wisdom. And thank you, Ravikant sir. Thank you for the audience. And look forward to having more engagement with you, Sahil.
Yeah, thank you, Ankit. Thank you, Ravikantji. And thank you, everyone. Thank you. It was a pleasure talking to you. Thank you so much.
Thank you, everybody.